This presentation will cover livestock risk protection insurance as part of a marketing plan. Cattle are a commodity, which means they're raw material that's traded on the futures, and prices are based on averages. For the purpose of this presentation, we're going to look at two segments of the beef supply chain, the cow-calf and stocker-yearling phase, in terms of how they might utilize livestock risk protection insurance as a risk management tool. Livestock risk protection insurance protects against prices falling for feeder cattle and fed cattle and is underwritten by the USDA Risk Management Agency. When you're using livestock risk protection insurance, you buy the insurance through a crop insurance agent, not through a commodity broker. And when you're buying the insurance, you're filing a specific coverage endorsement, meaning you're buying insurance for a specific length of time. The insurance is subsidized. The premium is subsidized 13%. Another thing to understand about the insurance is there's no minimum number of head that you can buy the insurance for. You can insure as few as one head up to 2,000 head in the July 1st to June 30th year. So you could insure 2,000 head July 1 to June 30th of one year, and then insure another 2,000 head July 1st to June 30th of the next year. That's one of the advantages of the insurance, is the flexibility in terms of number of cattle that can be insured. Livestock risk protection insurance is based on the Chicago Mercantile Exchange feeder cattle futures price. Closing prices are based off the Chicago Mercantile Exchange 12-state feeder cattle index that's based on auction market results. One thing to understand about livestock risk protection insurance is it does not take into account basis risk. So depending on where you're located, when you sell the cattle, how you sell the cattle, what class of cattle you sell, the price you receive will be either greater than or less than likely than what you protected the price for utilizing livestock risk protection insurance. One place to go understand what the basis may be for your location for when you're selling cattle and the class of cattle that you're selling is go to beefbasis.com. This website shows long-term historic data on what different cattle would have sold for based on in comparison to the CME feeder cattle futures price, and will give you an indication of what the basis might be for you locally if you were to sell those cattle in comparison to the Chicago Mercantile Exchange feeder cattle's future price. Livestock risk protection insurance classes of cattle are broken into a number of different classes based on weight and also based on sex, as well as breed influence. There's two weight classes, under 600 pounds and the 600 to 900 pounds. And those weight classes are further broken down by steers, heifers, Brahman influenced or dairy influenced. This next slide just shows how those different classes of cattle are broke out. For steers that are under 600 pounds, you can insure those for 110% of the CME feeder cattle futures price. And that makes sense when we understand that the futures price is based off of steers in that weight range of over 600 pounds to 900 pounds. Down below you can see that that's what the Chicago Mercantile Exchange feeder cattle future price is based off of, and so they're valued at 100%. Heifers in that 6 to 9 weight range are valued at 90, Brahman influence at 90, and dairy influenced at 80. Livestock risk protection insurance coverage is for several different week periods, ranging from 13 out to 52 weeks. What I find frequently is those shorter week periods are the ones that are most often offered, and those that are out over 30 weeks tend to be less offered. Livestock risk protection insurance is an alternative to futures and options. When I work with producers, the idea of going out and buying a futures contract where you might be subject to margin calls can often be a negative in the eyes of many producers. Also, in those kind of situations with futures and options, we're often looking at doing something that would involve comparatively against a load lot of cattle, and many producers don't have load lots that would fit those specs, and so they're hesitant to use those tools. This is single peril insurance, which means you're only insuring for price, no other risk. If you are familiar with futures and options, livestock risk protection insurance works like a put option and it allows you to set a floor price while leaving the upside open so that you can participate in market moves to the upside should they occur. Another thing to understand about the insurance is that the insurance goes with the cattle if they're sold more than 30 days prior to the ending date of the policy. Often greater insurance coverage is available in terms of greater options are available when the market is moving up or has been moving up for several days. If the market's been trending down or moving down hard, there often are fewer options available to buy in terms of insurance. This is the RMA USDA website where you can go and learn more about the specific policy requirements. There's a link there to look at how this would have performed historically if you wanted to go look at a specific time period when you might have bought the insurance for a specific closing date. You can go look at this website and find the resources there to provide you additional information. I think it's also helpful in a situation like this to work through an example, and so I'm going to look at one here today. We're going to look at some steers weighing less than 600 pounds, planning to market those in early November. We're going to buy the insurance in early August, and the reason I picked this date is Dr. Jay Parson and Dr. Kate Brooks did an analysis looking at buying insurance on August 6th, or if August 6th fell on a weekend, buying it on the next Monday or the earliest next date that they could, for looking at early November delivery, or basically a 13-week insurance policy. So in early August of 2016, the Livestock Risk Protection Insurance based off November feeders was at $142 per hundredweight. Again, we're insuring steers that weigh 550 pounds, so we would take 110 times that. The coverage price that we could insure for on that date was 99% of the expected ending value. That was the highest insurance offered. The cost per hundredweight was $6.36 per hundred, again with an ending date on November 7th. If we bought the insurance for 550-pound calves with the subsidy, we would spend $5.54 per hundredweight, or a little over $30 per head. When we go out to November and see how this would have worked out for us, we had protected those calves against $142 per hundredweight November feeder futures. The Chicago Mercantile Exchange price for that week when we would have marketed the cattle, or the closing date for the insurance policy would have occurred, was $126.56, so a significant market slide. When we bought the insurance, it cost us $5.54 per hundredweight, and so that protected price of $154.74 minus $5.54 is the actual price at which we begin to collect an indemnity that benefits us beyond the cost of the premium. And so that price was $149.20. Actual ending value was $139.11, so we take the insurance paid premium beyond the cost of the indemnity minus the actual ending value, which means we netted back to ourselves around $10 per hundredweight, or about $55.50 on a 550-pound steer. So that was 1 year, but how would this have performed over a several-year period? And Jay Parson and Kate Brooks looked at that, and they purchased the insurance annually on August 6th, targeting an early November delivery date or market date. On average, over the time period they looked at, you would have averaged a net of $1.55 per hundredweight by buying the insurance. Here's what it looked like for the first 5 years. In 2005, there was no advantage, but in 2006, 7, 8, and 9, buying the insurance was a significant advantage as prices declined from the time when the insurance was bought through the November time period. Over that 2005 to 2009 period, buying LRP on that early August date at the highest level offered on that day would have netted an additional $35 per head on a 550-pound steer. Now looking at 2010 to 2015, we can see over this 6-year period that it didn't look so good. In each of those respective years, except the last year, 2015, buying the insurance would have been a no benefit. During that time period, prices were either close to what the insured price was, or prices actually increased. And so we could look at this one of two ways. We could say, well, we bought the insurance, but we didn't collect anything. That really wasn't to our advantage. However, we did protect a down price while leaving the upside open, and so we got to participate in the market price increase. This was especially significant in years like 2014, when there was a significant increase in price, where if we'd have sold those calves against a futures contract, even though the price went up, we would not have got to participate in that increase in price. So from 2010 to 2015, using LRP would have cost us $13.50 per head on a 550-pound steer. Again, we looked at 2016. The benefit in that year, using it last year in 2016, would have netted us an additional $55.50 on a 550-pound steer. So, advantages of LRP. First, I think one of the primary advantages is that you can insure as few as one head. And so this can give you flexibility in terms of how you might use this risk management tool. You don't have to insure for load lots. The insurance is subsidized 13%. When you buy the insurance, your cost is known. And so the money's down. You're not at risk for margin calls in a scenario like that. I have found that lenders do appreciate when their clients come to them and say, hey, I have an opportunity to protect the price. I can make a profit at that and repay my loan obligation to you. I find that lenders are very willing to extend additional operating credit to their borrowers so that they can go out and use a tool like Livestock Risk Protection Insurance that helps ensure that they as a lender will get a return back to the capital that they've invested in that cattle operation. The real advantage of Livestock Risk Protection Insurance is that it protects the downside while leaving the upside open. So you get to participate in market prices increases should they occur while protecting against a market fall. Some of the disadvantages. Insurance options are limited at times in terms of what you can buy and what's available. There's only a narrow window when you can buy the insurance between the close of the Chicago Mercantile Exchange and when the rates are published for that day, and until that Chicago Mercantile Exchange opens the next day. So you have to have your ducks in a row. You have to have your paperwork with your insurance agent ready. And if you see an opportunity that you want to take advantage of, you need to move quickly. Premiums can be expensive, and we saw that in last year's example of 2016, spending almost $30 per head to protect a price. And for many folks, the cost of doing that is a little daunting. And so I think that is one of the challenges. There is basis risk. We've already talked about that. The price you receive may or may not be close to what you've protected the price of the cattle for. And then volatility can shut down Livestock Risk Protection Insurance. Either volatility to the downside or upside can really limit for a time what options are available that you can buy in terms of insurance. And then the disadvantage of insurance being tied to the cattle. Unless you can sell the cattle as a group, if you're having to take the cattle to an auction market to sell them, trying to send the LRP insurance with the cattle would really be pretty tough. And so I could see that most likely in many cases seeing insurance being tied to the cattle if you have to sell them more than 30 days prior to the ending date of the insurance, potentially being a negative. There are some livestock risk protection insurance resources that you should be available to you or are available to you that you can go see. These are UNL NEB guides looking at both feeder cattle and fat cattle. Also, Jay Parsons and Kate Brooks. The research data that I cited in this presentation is in the August 15 issue of Beef Watch, and you can see how they did that analysis and the conclusion that they came to from looking at that over a several-year period of time. In summary, I think livestock risk protection insurance may have a place in a risk management plan. I think it's really targeted toward cow, calf, and stocker yearling producers, and especially those who aren't dealing in large volumes where they have large load lots of cattle. That doesn't mean that people who are dealing with load lots can't utilize the tool. I just think that there's more advantage to those folks who maybe don't have load lots in terms of what this tool offers. And finally, I see it really being utilized by producers who are risk adverse, either because of their temperament and their, adversity to risk, and then also maybe in a situation where financially they can't afford a major market move down. And so that's where I think those producers have an opportunity to use a tool like this to protect themselves, especially if they have a lot of borrowed capital invested in their cattle. Finally, if you have questions around livestock risk protection insurance and how you might utilize it, please feel free to contact me either by email or by phone.